Hi everyone, welcome to the Timing Research Show for April 11th, 2016. Today we will be talking about the 133rd weekly report from Timing Research. My name is David Kosmeter, I'm the creator of Timing Research, and we did have Matt Buckley scheduled to host again today, but he had to do some last-minute traveling, so he got Doug Robertson to the host for today. So I'm going to go ahead and turn it over to Doug.
Well, thank you very much. I guess I'm the alternate, the backup host for the day. But yeah, I appreciate you having me here. Been on the show before. This is always a fun session. Good chance to talk with some sharp people about different trading ideas and get some thoughts tossed around. So let's see. I guess let me run through the room here and I'll see if everyone can introduce themselves. Give a little background, who you are, where you're coming from the market point of view, and then we'll start to dive into this. So I guess let's start from the top of my list here. Larry, you're from Power Cycle Trading, Larry Gaines. Could you give us a little bit of your background here?
Yeah, thanks, Doug. Thanks for having me here today. Yeah, and so Power Cycle Trading is a trading educational site that I started back in, I guess, 2010. I've been professionally trading for over 30 years, ran a very large trading company, international trading desk for over 10 years, and been focused of my trading career has been pretty much from the oil side, but my company, Power Cycle Trading, we focus on directional trading using options for defined risk and risk management. So I like to trade directionally using some of the tools that I've developed for that. And then I like to use the options just for better risk management, controlled risk, and also do a lot of what we call seasonality trading. I look at seasonal trends for oil, energy, things like that, and do a lot of different types of oil spreads, crack spreads, timing spreads, a lot of different things there. So a lot of fun.
Ah, sounds good, and good to hear the options part of that. It's my focus, and so we'll have a little bit of fun talking about that.
Yeah, absolutely.
Yeah, and it's good to have a directional guy here because I think everybody in the world is looking to figure out what the direction is.
Confusing at the moment, which we'll talk about.
Exactly. So, Ed, we have Ed Carlson from Seattle Technical Advisors, and as I was chatting with you before, I saw your Lindsay report out. Can you give me a little background on yourself and introduce yourself?
Well, yeah. Hi, Doug, and hello to everyone. I run a website called SeattleTechnicalAdvisors.com. We cover equities, foreign and domestic, developed emerging markets, commodities, treasuries, the typical stuff. The one thing that sets us apart, however, is we use the work of George Lindsay. Now, most people, if you even know the name, know he's kind of a footnote in history. He was active and well known actually during the 1950s and 60s, early 70s. But he never wrote a book, hence his name's kind of disappearing, I'm afraid, even though he wrote a newsletter for over 30 years. I was able to find a lot of these old newsletters and piece together what he was doing through a lot of partial explanations of his, and I've written 3 books, published 3 books of my own on his work. But we're publishing 5 days a week here at the website and invite anybody to come by for what we call a sneak peek at the research.
Sounds good. It'll be interesting. I'm looking forward to seeing a little bit of a different perspective on things.
Right.
So this will be good.
Henry, are you there now?
Henry is a trader and a Mickey Mouse impersonator.
Does he know he sounds like that?
I hope
Sounds
so.
like Chip and Dale.
There we go. Oh. Time to log out, Henry.
Yeah, you might need to restart your computer or something.
Okay, well, we're waiting for Henry to get sorted out here. James, Alpha Shark. You and I were talking a few minutes ago. Your options focused. Love to hear something about you.
Yeah, so I'm an options guy, but my approach to trading equity options is probably pretty different than the approach that the rest of us might take. What I spend all of my time doing, and pretty much all of the trading day doing, is looking at the tape and trying to pick out large, unusual, suspicious-looking block trades in the equity options market, because those are the orders that are coming from institutions. So I only care about enormous, high-premium level bets being made by hedge funds, mutual funds, sovereign wealth funds, the biggest participants in the market, and I'm trying to pick out those trades and then determine, based on that information, what their directional leaning is in individual equities and ETFs and indices, and I can glean a lot of information about where institutional money is pressing their longs, pressing their shorts on any given day, and I can use that information and that order flow to try and trade very similar to them. We believe that institutions are the ones out there that create all the momentum. They're the ones who kind of control this market with their money flow. So equity options gives me a really good window into where they're putting on leveraged bets. And in times when markets are slow and there aren't as many trades coming across, we also actively day trade with technical analysis methods like the Ichimoku Cloud, and also run some catalyst trading plans that we look for equity option setups around earnings.
Well, it sounds good. I mean, to be honest with you, I'm going to be really interested in talking to you today, because my focus right now is options, and I teach options. I'll go into that in a second. But my background is I actually started a high-frequency trading firm back in '99, and we actually tapped into a lot of that institutional order flow data and the dark book data to do, on a very short time frame, a lot of what you're talking about. So I'm going to really be curious to see how that's translating over into the options world. So both on this session and outside, I want to pick your brain. So it looks like Henry is having a little bit of technical difficulties. We will get him involved just as soon as he hops on. Oh, Henry, are you here?
How do I sound now?
You sound better.
I don't understand that one at all, I'll tell you.
It's technology, we just, it's kind of one of those things you just pray it works.
And then it doesn't when you need it to. So.
And then it doesn't, exactly. So Henry, I hadn't had a chance to talk to you before we got going here, but you're from TradeAlert.com.
I am.
Who are you, and what's your background? What's your perspective on what's going on with this?
Sure. So my background is almost 25 years of options trading. It's kind of the only thing I've ever done. Started out as a market maker back in the late 80s, and then transitioned to electronic trading and institutional trading. Most recently for Bank of America, which is where I ran electronic market making and also customer option trading. For the last few years I was there, and then about almost 10 years now ago, I started TradeAlert, which is a market data firm focused exclusively on option flow analytics. Mm-hmm. Everything, it kind of grew out of a project that we started at B of A but never actually completed, which was to build a tool to let people, to let our desk effectively compensate for the fact that things were becoming automated and fragmented. And at that point, there were only 4 exchanges. Now you have 14. Mm-hmm. So what my firm does is we've built software and have hosting arrangements to process every single option market data event, which is billions of quotes and millions of trades, and turn that into usable data for traders and for salespeople. The range is basically, if you think about a big trade and people need to know about it, in real time and what was it, to a much higher level aggregate analytics. What does the normal volume look like in Pfizer, and how does today compare to that? And from there you just kind of keep running, and that's what we do. And I still trade a little bit on my own, and one of the best things about kind of what we have is, our users are basically every single big bank, and then we also have a lot of prop traders, a few individuals, and we're talking to those people all day long, and so we get a very good feel for when things are hitting the fan and when everybody's asleep. So
Sure.
and everything in between there.
kind of funny because I think that you and I were probably on the opposite side of the game for several years. I ran a high-frequency trading operation that did the exact same thing but the opposite side. I was tapping into all the high-frequency data and making short-term millisecond level plays on a lot of, actually we were mostly focused on equities as opposed to options, but I actually come from the other side of the world from where you were, from the institutional side. I was the buy side.
Right. Okay. It takes you got to have every little player, and everybody kind of plays a part, and things change, and the hot potato gets passed around, but
absolutely,
it's what makes the market.
Oh, absolutely. Yeah, sounds good. Well, thanks. I appreciate it. I guess I'll kind of give everybody a bit of a background for myself. My name's Doug Robertson. I work for Top Gun Options. I do the Advanced Live Trade Brief education service. Basically, we take an advanced approach to options trading. I don't shy away from fairly complex trades or subjects. We do a lot of, within my sessions at least, we do a lot of implied volatility trades, your standard stuff, your credit spreads, iron condors, things along those lines, but also playing some very specific implied volatility shifts and things along those lines. Originally, I started out as a computer geek and a math geek way back when, and had an opportunity to get into had a specific opportunity to do a startup, and I was basically the president of a high-frequency trading operation. We started out with straight arbitrage back in '99, using basically computer-based arbitrage, and then moved into high-frequency models, market making, liquidity trading, wide variety of different models, cascade models for high-frequency trades, things along those lines. Moved from there into derivatives, started doing forex, futures, and options, and let me see, worked in New York City, commuted actually for 5 years, got irritated at that whole situation, ended up dropping out of the world, moving to the Bahamas, and managed a trading operation from a small hut on the side of a beach in the Bahamas. Moved up to Chicago, worked on LaSalle Street for a while, and then finally figured out that Chicago was extremely cold, and it didn't have any place to ski. So I moved to Florida. So now I do trading operations.
It's better skiing in Florida?
No, but it's a lot warmer.
I gotcha.
So if I'm going to have something, I gotta. So now I teach options trading. I manage my own funds. Do a handful of high net worth individuals that I manage money for, and live a little bit more enjoyable life. It's nicer to, a little bit lower key than having to commute from Portland, Maine to New York City on a regular basis. So that's my background. Looking forward to talking to you guys about what's going on out in the market. So I guess we'll dive in here. Big question big question for today is, based on any technical or fundamental indicators you want to use, I'll open that up and just say, based from your perspective, wherever you're coming from in the markets, what do you predict the S&P 500 will do between today and Friday? What's your movement? What do you expect to see? So let's see. I guess we'll just run down the list. Henry, you're at the top of my list, and you're on right now. So what do you think is going to happen between today and Friday?
Earnings season is finally starting to kick off. So, we'll see some big ones this week. My general feeling on this market is, interest rates are finally going up, although it's, slow. Energy's stabilized, after a pretty hairy beginning of the year. I don't know if people want to put new money to work in this market, except that there's not really anywhere else to put it. So, I pay attention to kind of what a lot of people are saying. My feeling is we've had a pretty good run, and this has got to be the tail end of it. So I'm just kind of looking for the market to keep chugging around, which is what it's been doing. There's certainly been pockets of excitement. but kind of we're right back here. We're basically flat on the year, with some nice 8% moves. And I think it's just going to be a little bit more of that. So my feeling is that we're going to be relatively flat, well into the summer. Although I do think we'll see 2-3% here, 2-3% there. But in the end, I think that it's a very good market for stock pickers. It's a good market for traders who can be disciplined and sit on your hands and don't do anything just to do something, which is always a big challenge.
Definitely a big challenge. So Larry,
Yo.
You are the direction guy here.
Okay.
Direction. What do you see between now and next Friday? S&P 500.
Yeah. So right now we're kind of lingering. We're in what I call kind of a transition mode to the market, where it's just kind of going sideways. If you look here, you can just see. If you can see my charts here, I'll just extend this out. So if you look at the S&P, here's just a weekly chart. So we've got these highs are lower. We've got this little descending trend line. We're up against some resistance based on Fibonacci here, but we've got good solid moving average support below. So I'm looking for the market. I mean, it could either grind higher or drift back. I'm looking for a little bit of a drift back, just because we've had that great move up. We've had a good timing move. You can see the timing. Like 2 weeks up, 2 weeks up, and now it's just kind of trending sideways. So I'm looking for it just to kind of drift back. It's a stock pickers type market. You want to look for those that have good momentum. So one thing I'm really focused on currently will be looking for the earnings type trade setups, free earnings on Netflix and Amazon, which will be coming up. And if you can get Netflix or Amazon to break above their current resistance levels, those things could take off, and that could stimulate, add some momentum to the markets. If you just look at the options expected move for this week on the S&P or the SPY, it's saying the market could go up to about 2075 on the S&P SPX, or down to 2530. So not looking for a whole lot this week. The banks are going to have their earnings, but I don't see that as a big catalyst. I think next week will be the big week. You've got, we were talking a little earlier, we've got all the big, momentum type stocks. Will be, a lot of them are reporting next week: Amazon, Netflix, Google, Microsoft. So I think next week will be the hot one. We've got, then again, oil's been creeping up, but it's coming into some major resistance. You've got OPEC meeting coming up Sunday, so I don't see much happening to oil. It's just going to kind of grind up here. We've got some major resistance coming in here, 200-day moving average, etc. So Wednesday will be, inventories, DOE. I'll be watching that. If we get another draw on crude, that could pop us through some resistance. But I'm surprised. I'd be surprised to see another drawdown there. So all in all, just kind of, to me, I think this week will end up a little bit lower. Nothing too extreme one way or the other.
Yeah. Okay. Now, actually, there's one thing you said there about the banks. I mean, I'm a little interested to see what's going to happen to the banks, especially J.P. Morgan, because there's this one little bizarre fact that most people aren't kind of putting into play, and we might see a bit of a surprise on those banks. When the Fed started its rate increase, it also did a corresponding increase in the excess reserve rate that they're paying the banks. And we've got $2.7 trillion in excess reserves, and J.P. Morgan, which is coming up, let's see, the 13th, has one of the largest excess reserve accounts out there. They're getting basically free money from the Fed, and that goes directly to their profits. I'm not disagreeing with you on the banks are generally fairly boring, but I'm wondering if there might be some surprises hidden in there. It might perk up the market's ears a little bit if they see some surprising news out of the banks. But who knows? We'll see. Let's move on. Ed, Seattle Technical Advisors. What is the Lindsay perspective on this?
Well, when you're trying to figure out what the market's going to do the next 4 days, it's, you got the better odds of flipping a coin and figuring it out. At least I do. I don't know. I've got what I call a low confidence forecast for a low near Friday, so that would have me thinking the market's going to pull back into Friday. So I guess I'll have to say low. You know what I'd really like to do with the time that's allotted to me, I'd really like to throw it back to Henry and ask him to expand upon his comment that interest rates are coming down now. I've heard other people say this, but when I look at a chart of the 10-year, I don't see interest rates going up. Sorry, Henry. Henry said they were going up, and when I look at the chart, I see rates in a downtrend. So maybe I could turn over the remainder of my time to get a better explanation on that.
I'm happy to shift it back to Henry for a second if you want to answer the question.
Sure. I mean, I'm just going off of the perception that we're finally in. The QE is over, and that the Fed is going to, do what they said, which is, a measured pace of normalizing interest rates. And you're right. It's a snail's pace, but I think we need to get things back, and I think the Fed knows too. I just heard Dalio on NPR yesterday, I think. The Fed knows they need to get some bullets in the gun for something that that unforeseen that might pop up later this year or next year, and we're kind of in a dangerous spot, and I don't think the Fed is happy with this negative interest rate thing that they're seeing in Europe, and so that's what I'm saying is people are kind of realizing, okay, it may take 5 years to get back to 5%, but we're in an increasing rate environment, opposed to a decreasing rate environment. And as you know, there's a lot of traders out there that have never really worked through that and don't really know how to deal with it. So I think it's one of the reasons that people are like, well, gee, that's although it's good for some stocks, in general, it makes stocks less attractive. So I think that's one of the headwinds is all I meant.
Okay, thank you.
I think one thing I'll toss in there is I think that the prediction of 5 years may be a little optimistic for 5%. At this point, I'm wondering if my daughter's going to be through college before we see 5% again. But you're right. The Fed needs to reload its gun, and it's desperate to do that. But at the same time, we also have Janet Yellen in the New York Economics Club sitting there, and she was basically handing out market candy. She was talking about quantitative easing X in the form of bond buying programs, and saying that they're willing to go do that. It's a real mixed message we're getting from the Fed right now. And every Fed governor that floats around and lands in front of a camera seems to have a different message. So we'll see what happens. Let me move over to James. James, Alpha Shark, what's your perspective? What do you think is going to happen over this week?
Yeah, so I think it's going to be a relatively uninteresting week, price action-wise, in the SPOOs and the S&P. We're looking at a market that last week just could not manage to hold a rally, and I think what that's all about is expectations for this earnings season, as Henry kind of said, with at least somewhat of an established pace for the Fed's schedule for rates and energy markets kind of stabilizing. That's the next big point of uncertainty is earnings. Alcoa reports today. That's kind of the unofficial kickoff of the next cycle. And I think that right now big money is kind of sitting on their hands a little bit, waiting to get through some of these reports to get a better idea of where we stand. Expectations are very, very low. So I think that as we move into the end of the week, we'll probably see some sellers come in. We just saw the market rally back today, but we're already coming under pressure and are off of the highs. So, I think that there is sellers in the market that are waiting for rallies ahead of earnings here. And with that in mind, I think we're going to be slightly lower, but nothing too crazy of a move to the downside. Once we get into the cycle here and we have 100 stocks reporting earnings every day, then I think we'll get a little bit more action in the S&P. But until then, I think we're going to be it's going to be pretty quiet.
Yeah, I can respect that. From my point of view, and I guess my answer to this is that I think we've got a lot of conflicting motivations in the market right now. I probably the one who is a little bit outside of the norm here. I actually do consider fundamentals, but I also clearly realize that fundamentals mean nothing between now and Friday. The fundamentals in the long term are weakening. And we're looking at going into the fourth quarter of an earnings recession, a corporate earnings recession. Sales are going down and earnings are going down, and that is raising the risk level in the market. I think that's going to cap out the top end of things. But at the same time, we've got the Fed tossing out, as I mentioned before, the market candy. Yellen is basically saying, I'm willing to buy bonds to drive rates low. I'm not going to let the market go down. And we're mixing that with a conflicting message of we've got to raise rates, which is exactly opposite of that. There's no clarity in the whole thing. Aside from the note that I had about the banks maybe getting a little bit of a nice unexpected boost because of the excess reserve rate that the Fed increased from 1/4% to 0.5%. By the way, 1/4% on let me see, what was it, $800 billion over at J.P. Morgan is a nice little return. And that's all managed by a very small group of people. That's probably one of their highest profit groups within J.P. Morgan. They do nothing and they make enormous money. Aside from that, there isn't a lot of driver. I think the market is really trying to sort out where it's going. If I have to call a direction up and down, I say a mild down, mainly because I think we are up for a pullback from this significant rally we've had since the most recent correction. If anything, I think that there's just so many people out there on a short-term basis that have an anxiety that the market can't go up too much more. And we are setting these lower highs on a progressive basis. I think that that's going to push the market down a little, but I'm not talking much. I think that we've still a lot of positive pressure out there that's fighting to keep the market moving up. I don't know where it's coming from. It certainly isn't from me, but something wants to keep moving these markets up, and I can't fight it. I mean, I can tell the markets what I want them to do. They just don't ever seem to listen. So, running around the same question again, we just said what we thought was going to happen. Now, how confident are we in that? I'm going to add one little twist to this. If your idea of what's going to happen fails, what do you think is going to cause it to fail? What are some of the things that could, how confident are you that your prediction is going to be right? And what are the things that you think could come along and basically derail what your prediction is? So let's go back to Henry. What are you thinking about there?
Well, I think you're right on earnings. If there are some surprises, maybe we could get a little bit of fireworks. I mean, one thing that stands out to me on how this year has gone is just how quickly things can turn. I mean, the traders, option guys, talk about the volatility of. Well, they talk about volatility all day long, but they also talk about the vol of vol. Mm-hmm. And to see VIX go from 14 to 30 and then back, it tells you that there's not a lot of depth out there in terms of the conviction. Mm-hmm. Like I said, I think that money keeps flowing into the market because there's there's nowhere else to put it. Mm-hmm. But I don't think it would take much in terms of ugly headlines, surprising earnings, whether it's good or bad. Then you could see a 4% run, in a day or two, which would surprise people, and that obviously leads into, if it's to the upside, you get everybody who's underperforming, and you're trying to chase that, and if it's to the downside, everybody freaks out, which is kind of par for the course. Creates all sorts of chaos and opportunity, and it's kind of like that's what you want. A day like today, where we're just SPOOs are moving $5 or $6, that doesn't really do anybody any good. We just kind of sit here.
Yeah.
Gives us time to have a nice chat, though.
Yeah, it is. It is.
So that's good. We're not missing anything.
Yeah. Well, one of the things, especially when you're talking about the volatility of volatility, one of the things that I've been watching a lot is the huge premium that the futures market, the volatility futures, the VIX futures, are putting on the VIX rate now. I mean, we've got a $2 spread between the April the X contracts, the futures contracts, and the underlying at this point. The futures contracts are building in a huge, upward swing. But to be blunt about that, they've also been wrong for the last 3-4 months. So we'll see what happens there. I don't know. All right, so let's move on. Larry, what's your once again, what's your position on this? We gave the prediction. You've got to give me your opinion on what you think is going to happen between now and Friday. How confident are you, and what do you think are the things that could derail that, and what are the risks to that prediction?
Yeah, so I said earlier I think it's going to drift lower, but what could potentially derail it this week for me would be just oil, and that will be the oil inventories on Wednesday, the Department of Energy. So they'll come out at 9:30 Central. Now, last week we had a surprise draw on crude oil of over 4 million. We had a build on gas, so that popped crude up, and we have those inventories again this week that everybody will be looking at. In Cushing, Oklahoma, Pad 2 is where the draw was, which is where all the storage is. So from a standpoint of something that could give some momentum to the market or give some stability or some kind of catalyst is what we need, that could be the thing for this week. I don't see a whole lot of other kind of catalyst events for this week. You've got the earnings on banks. I'm not sure how much that will impact things that much, but if we get another draw on crude for Wednesday, I think that could pop crude higher. Not much higher, but high enough to push the markets S&P to the upside of the range.
So, Larry, you're talking about oil right now, and I've had a question that's been running in the back of my head forever, and I'd love to pick your brain on it.
Okay.
All right. The oil in the markets have traditionally, over the last, umpteen years, had a negative correlation with each other. Oil prices go up. Generally, that's an input, that's a commodity into most of the industrial processes.
Right.
Causes prices to go up. It's a drag on the market. Why do we have this positive correlation between oil and the markets right now? Why is it? It's an intense correlation. It's very, very highly correlated, except for maybe the last couple of weeks.
Yeah.
What's your perspective on that? Why is that happening?
Well, I think it's been the template for global demand. So that's one thing everybody's been watching are the commodities, just to see when global demand will come back in and shift back to the upside. So the biggest one of all is energy, and then you've got the metals. But so we've seen I think the bottom's in on energy. If you look at the rebalancing of the oil markets, you can see that production's been coming off every week. If you look at the inventories, they're about to break back below 9 million barrels a day. You can see that the Baker Hughes rig reports every week have been declining. So you're starting to see the impact of what the Saudis wanted to do, flood the oil markets, put a lot of guys out of business, which they really haven't done, but they are cutting domestic production in the U.S., and so that's going to start rebalancing things, and it's like a big oil tanker ship. You can't turn these things around real quick. So once that momentum to the downside started, you've got all these rigs coming off, you've got production going lower in the U.S., it takes a little bit of time for it to get back to the other way to swing that pendulum back. And in the meantime, you're going to have global demand pick up. It's not going to go lower. The GDP estimates are still for an increase over 2016-17. So when we get into 2017, just if you look at the all the different numbers, you can start seeing the differential between supply and demand narrow, and that's what will cause oil prices to push higher. But these are things that the market looks at, and they see it up front, or they look for it, anticipate it, before it happens. So I think we're starting to see that happen a little bit now. But that doesn't mean that we can't get a pullback. But I think the lows are in for the oil markets.
So let me see if I can get this. You think that the correlation that we're talking about, though, is mainly caused by oil being a proxy for worldwide demand?
Absolutely.
Okay. Okay. All right, I could see that. I'm just, it's one of those things that's been confusing to me because it's not a natural correlation. If you had have asked somebody what the correlation between oil and the market was 10 years ago, you would have gotten an entirely different answer.
Yeah, if you look at it, though, since we've been coming off, that's the whole focus has been, okay, oil, and that's been a proxy, like you say, for demand. China has not been buying as much oil as they used to. So you look at that impact, and that's kind of what I think the whole global eyeballs are on that particular part of the equation.
Well,
And
I think
they follow it. With oil is the simplest way for them to look to see when that demand shift starts happening again.
well, I think anybody is looking for insight into what's going to happen in China. I mean, that's our elephant in the room right now.
That's
I mean,
a tough one.
yeah. So, all right, let me move on. Ed, once again, you've got your idea of what's going to happen over the next week. And I know that you're coming at it from a bit longer-term point of view, but what do you think things could, be to unsettle, your predictions about what the near-term future are? What could upset your views at this point?
Oh, I think I'd probably go with Larry. I think it's oil. When the price of oil goes down, everybody gets worried about these energy producers, drillers, what have you, defaulting on their loans and taking the banks with them. Mm-hmm. And the algorithms are all set up to trade in that direction. So when crude goes up, whether it makes any sense or not, it takes the equity markets up. And so given I have a bias to the downside for the rest of the week, if crude breaks out over 40 here, and I mean a significant breakout, not like we're seeing today with 8 cents over 40, then I'm going to have to do some head scratching on that downward bias. I actually think crude's got one last leg down in it, probably something closer to $23 a barrel before we really get started. However, I did write a commentary this morning at Trader Planet saying that I believe the broad commodity market has had a turn. We saw a 3-year cycle low, and gosh darn, I'm forgetting now. I think it was in December. It's in our rearview mirror, whenever it was. And I do think the tide is for higher commodities going forward.
Mm-hmm.
Now, how long that'll affect the equity market, I don't know, but we're already past your 4-day window in discussing that.
Oh, yeah. I mean, it's one of those things, and I think we all here know that making a prediction over 4 days is a interesting challenge at best. Yeah. I'm gonna put a little bias on my coin toss here.
Right.
So James, what's your view? Same question, same thoughts. Where we know your opinion about what's going to happen over the next week. What could derail that? What are the biggest risks, and how confident are you about that?
Right. So, I mean, when I have a view that we're not going to see that much action, but slightly lower, I'm about as confident as I can be with that. I don't think we're going to end significantly lower this week, but I think the risk, to the upside would be, as pretty much everyone else mentioned too, a significant breakout above $40 in crude. This morning, it kind of looked like we were going to get that, but if anything, I would look at the move today and say that breakout is kind of failing here. We're about 70 cents off of the highs of the day here in crude and testing the $40 level right now, so I don't think we're going to get it today. And it does seem like there are, again, sellers interested to sell rallies in crude. That being said, another big risk would be just, blowout reports from the stocks that are reporting earnings this week. I don't think that we're going to get that. Alcoa has rallied like 3 times in the past 3 years on earnings day. So I think we're probably going to see a sell-off in that there. A lot of traders like to consider Alcoa as a bellwether for how the rest of the quarter is going to go. It has been proven statistically that that's actually not the case, but there are a lot of people out there that do believe that, and I would guarantee you that if they do have a big blowout quarter, there's going to be a lot of stock market bulls coming out of the woodwork to talk about how we're setting up for a big rally. So that might change things as well, but I'm fairly confident that that's not going to happen, and that we will see selling pressure throughout the rest of the week. But those are the 2 biggest risks, I think, for an upside move.
Yeah, the best analogy I can give for Alcoa is that Alcoa is kind of like the New Hampshire primary. It's popular because it's the first one out there, or the earliest one out there, but it really doesn't mean a whole heck of a lot. Man, this is a tough question. I mean, I'm always trying to gauge what the risks to my thoughts are, and I think we live in kind of a tough trading world because you have to almost separate yourself. You're trading from your opinions. In fact, that's one of the questions that we're going to get into here in a few minutes. But I think that we've got some fairly big risks to the downside if and when we have a rapid move. I think that the trading world is ready to jump on a mini correction of some type. When it's going to happen, I have no clue. Do we have anything this week that could surprise us and derail that expectation of kind of mild down? I'm looking at the same stuff you guys are, and I really don't see a whole lot of earth-shaking news coming up. But that doesn't mean we can't have something strange happen. And the one thing that's really surprised me in the last month or so, month and a half, is just how strong the market has been. Now, I don't look at this as a strong environment, but the market seems to have been able to move up. So I think if I've got a risk of my choice or my direction being wrong, it's that the market could just surprise me and move up again. Flip side of that is really we could have some form of trigger that cascades us down. One thing that I've not seen in the last year, well, basically the August correction and the New Year's correction didn't have a capitulation. It was neither one of those corrections had a true capitulation. And so there's still a lot of commitment to this market going up at this point. I don't know. It's a tough call. I'm not sure there's a terribly clear view on the whole thing. But I think we do have a relatively boring week coming up with a slight downside trend. Let's see here.
That was. Can I interject something to screw that all up?
Sure, absolutely. But yeah, absolutely, love to.
Somebody just bought 150,000 SPY calls that expire on the 22nd at the 210 strike.
Okay.
So that's not 1 week. That's 2 weeks, right? Those expire.
Right, 2 weeks, but that's somebody's making a fairly big bet there.
It's a bet. It's almost $2 million worth of premium.
Wow.
So that's a big trade, even for SPY, which does trade a couple million contracts a day.
Yeah.
That's a hefty one.
What was the time series on those options?
Those are the April 22nd 210 calls.
Okay, thanks.
18 cents for a couple, 150,000 total.
Wow.
Yeah, and it's not tied to anything; it's outright. So, what's interesting on some of those, you don't need, that doesn't necessarily mean that guy will make a double if we move up $2. So.
Right.
But it's interesting, and in my case, in my experience, kind of watching these. The follow-through does tend to happen, but not all the way. So, okay. We may see them kind of take half their money off the table in a day or two, and then we still could be down by the end of the week. So,
I guess the big fundamental question is, is he doing that as a directional play, or is that some kind of hedge against a much larger short SPY portfolio?
Yeah, that's always the question. I mean, and then when you have big earnings, it could simply be kind of an outperformance type of bet as well.
Sure.
So
you could have a long-short fund out there just trying to minimize their beta or something like that.
Exactly.
So I don't know. Yeah, that's always interesting to see those come through because it gives you some insight that people are making decisions. Figuring out what those decisions are is challenging sometimes. All right, I'll tell you what. Let's see here. All right, we're kind of repeating ourselves a little bit. But question number one, and I'm going to read some of the things back. This is from the questionnaire that was sent out. What developing events, technical or fundamental, will you be watching out for for the trading week of August 11th through April 15th? Negative or positive impact. I think we almost have covered that. Has anybody got?
Yeah, I think you guys pretty much covered that already. Unless anyone has any additional comments, you want to go on to question 4. That would.
Yeah. Does anybody have any thoughts or anything that they want to interject at this point? Just jump in and let's hear them. And gone. Okay. Now this one's question number 4 is interesting. This is going a totally different direction. This is kind of asking us as traders a little bit about how we function, which I've worked with traders since '99 officially, and traders are an interesting bunch. So what methods or techniques do you use to overcome the emotional aspects of trading? And I certainly have had my moments of emotion. I'm going to shift this around a little bit, and I'm going to go backwards on the list. So I'm going to start from the bottom. James, Alpha Shark, what methods or techniques do you use to overcome the emotional aspects of trading?
Yeah, so it's actually a pretty simple answer. Regardless of what I'm trading, whether it's a trade based on unusual options activity, a day trade that I'm taking in Apple weekly options based on a technical breakout, or a trade ahead of earnings, regardless of what the plan is, I'm always looking at the same pieces of information before I put that plan on. We tend to break these up into steps, and I analyze the same things every time. So for something like earnings, every single time, regardless of the stock, I'm always looking at historical performance on earnings day, what the market makers are implying the stock will do this time, a technical analysis that uses the same 5 key points to determine whether the stock's in bullish or bearish territory, and then setting up a trade using the same risk versus reward types of guidelines every time. And while the aspects that I'm analyzing change depending on whether it's an earnings trade, a day trade, an unusual options activity trade, I'm always doing the same things every time. And in these trading plans that we have, it also tells me exactly how I'm supposed to manage the position after I have it on. So I manage them the same way every time. And I think by looking at the same pieces of information for different setups, by having a defined plan to manage them before I even put the trade on, I'm able to remove a lot of emotion, because there isn't really any wiggle room there for me to make a rash emotional decision, because my trades are so well planned out and so well defined before I even put them on. And I think that's really important. Every single trading plan that we educate on and use in our daily trading is kind of built that same way. The main goal that we have is to kind of remove emotion entirely from the plan. So, having predetermined profit targets and stop loss levels based on, some variable that I can use every single time, I think is really important when it comes to trying to manage your emotions.
Okay. So kind of consistency and trading to the plan, building out a clear plan and then trading to the plan. Is that?
Yeah, absolutely. And, I try to avoid kind of ambiguous rules for stop losses and taking profits. So, for example, I'll always set my profit targets based on, however much I'm risking in a position, so I can get a certain profit factor or multiple return on my risk, and then we'll manage the trade after that. So as soon as I put a trade on, I know exactly where I'm going to be taking pieces off at a profit, and I know exactly where I'm going to get out of the whole thing if it goes against me. And then I'm not really even leaving myself room to use a stop based on if technical event X happens, then I will manage the trade this way. I like to be a little bit more kind of hard coded than that.
Okay, that sounds good. Let's see, Ed, how do you approach the aspects of emotional emotional trading, things along those lines? Same question. What are your thoughts on that?
Easy, one-word answer: alcohol.
Which, by the way, was actually, I'm looking at the list here, and that was one of the answers we got on the survey.
It wasn't mine.
Actually, I'm sorry, I don't mean to derail you for a second, but I do have some fun ones that we got on the list here.
Okay.
Let's read these out. We've got a lot of plan. Stick to the plans, things like that. Use my technical analysis. We got an interesting one. Being an adult. That is their strategy for handling the emotional aspects of trading. I'm an adult. I'm not terribly sure how good I'm at managing the emotional aspects of trading. But the real fun ones are, let's see here. Drugs and alcohol was one. Morphine was another one. This has got somebody taking it far past the drugs and alcohol. I love this one. Play golf and check on my orders only after the market closes. That's a definite strategy. And one I'm not sure I actually understand, but one of the responses was office yoga. So I'm going to have to investigate exactly what office yoga is. But so those are some of the thoughts out there. Now, I'm going to hand it back to you, Ed. I didn't mean to derail your answer, but...
Well, the office yoga actually makes some sense. Not that you have to know or practice yoga, but the idea that, it doesn't make sense. It's a segue to what I wanted to say, which was we've all heard the phrase "sell down to your sleeping point," right? If you're bothered enough that you need yoga or alcohol, you're probably in the wrong trade, or morphine, right? Now I'm an outlier amongst the four of us today. I'm not really a trader, although a mom and pop buy and hold investor might describe me that way. I'm more of a swing trader, position holder, and I'll be 2 weeks, 2 months, 4 months. Right now we're looking for the market to pull back into sometime in June, so I'll be short until then, or at least I expect to be, unless there's I have a dollar amount in mind when I put on a trade. How much loss can I accept? And when I hit that point, then I just have to accept that I'm wrong, and I get out until I can figure out what's going on. And so it's a hard limit. Price is always the ultimate indicator, right? For anybody, and that's it. It's a hard stop for me.
Yeah, I mean, you said it right there. The price is the ultimate indicator. I mean, the market's not wrong. You're wrong.
Right. Correct.
So it's sometimes you just have to listen to what the market tells you. So Larry, what are your thoughts on this? Emotional aspects of trading. What's your approach to making yourself a better trader or controlling that? Yeah,
that's such a huge question, and that's the biggest part about trading is just your risk management. So basically, from trading, you want to try to be as detached as you can, which is easier said than done. But in order to get detached and get your emotions out, if you can be as systematic as you can be, based on, I think Henry was talking about it, or forgot who was the first one that was out there, but have a total systemized approach for every trade you do. Do the same thing over and over, and depending on what you're looking at. So I use technical analysis for all trade entries, and then I'll do the same for the exits. But every trade that I take, before that trade is taken, I also have an exit plan if that trade goes against me. So I know exactly what I'm going to do. So I have a certain strategy that I do, defensive strategy using options, very simplistic, but it's great. It makes me feel comfortable and confident, and takes the emotion out of it. And then for putting on the trade, I also want to then also know where can it go. So I want to do my target analysis. That's very important. So I use Fibonacci, and I use the options expected move to see if it's a realistic target that I'm looking at for a specific trade. So if you do all these things and you have a checklist, not everything will always work out for you, but at least you're going to have it to know what you're going to do next quickly. You need to make quick decisions and have pretty much those decisions already made, so that's in your plan. That's what I try to teach, all of our members, and that's a really big core part of what I teach, actually.
Yeah, I've actually get a lot of the similar concepts on some of the things I teach. Is the fact that the plan itself may not be worth anything by the time you have to execute it, but the act of planning forces you to think through all the situations and realize that you may have to make some decisions in the future. And laying out how those decisions go means that you don't have to panic when they actually happen.
Exactly. You want to have those decisions almost already made, so you know exactly what you'll do.
Yeah, and I think that's a good overall strategy for helping people control their emotions and just do more logical and stable trades. So Henry, what's your take on the discussion here?
Can you hear me? Okay.
Yes.
I don't sound like Mickey Mouse, do I?
No, you don't. Or the chipmunks.
I don't know what was going on there. I would say that I would echo what Larry said, what James said too. Consistency is really your friend. I mean, my first boss and mentor in the business was Blair Hull, and he told me one time, and I didn't quite understand it, but he was like, it doesn't matter if it's wrong or slightly wrong. But as long as you're doing things the same way, you will kind of find out ways you'll compensate. But we all know what the rules are. You can look them up, right? 2 to 5% of your portfolio on a single trade, blah blah blah. You have to just be very consistent and very disciplined, and you will kind of that becomes the foundation, and you may tweak things a little bit here and there, but it's the loose cannon stuff that people commit trading suicide all the time, and it comes from some very human places. You get bored. You're like, yeah, you know what, I'll do 4 times as much on this thing, and I'll sit here and stare at it, and then you know how that tends to go. So I think consistency has to be appreciated as one of the most important pieces. And what everybody said, trading is really supposed to be pretty boring. And if you're coming into it because you want some excitement and you feel like Vegas is too far to go, so you're gonna punt on weekly options or something, you're guaranteed to well, I guess you'll learn your lesson and you will be doing something else very, very soon. So if you're gonna come in and treat it as a business and be very realistic. I mean, to say, hey, I got $20,000 and I'm going to make 50 grand this year on it, that's not very realistic. If you can make 10 or 20% a year, that's a good return. And you have to really be just realistic about the whole game.
Yeah, I agree. Actually, I'm going to say something on top of the whole consistency thing. I think that a lot of people don't realize that trading is a learning game. You have to constantly be learning what's going on in the market. You have to constantly be understanding, how is the market different? How's the world different that I'm trading in? And if you're just doing random things, there's no way to learn from randomness. If you just are winging it, how do you evaluate what your decision-making process was? Was it right or was it wrong? You can't actually learn from that process. So consistency, beyond giving you control over the emotions, gives you the opportunity to learn and become a better trader. And I guess I'll dive into my answer on this one too. I mean, I think everybody has hit some really good fundamental points. I'm not sure I have much to add on those, but I will toss a couple other things that I try to blend into my own trading process that I'm not sure if it necessarily completely keeps emotions out of the game. I'm a competitive person. I like to win. And I'll put it bluntly, it pisses me off when I lose. Therefore, emotions affect me, and I have to catch that. I also realize that I'm a little bit of an arrogant person at times, and I feel like I know too much about the markets, and I have to wake up in the morning and pretty much just smack myself in the face and remind myself that I'm not a genius. To trade what's the market doing and to keep things simple and straightforward. One of the big things that's helped me manage emotions is to make each trade that I take actually less significant. My big goal now, as opposed to what it used to be when I first started, is to trade a portfolio. And to a certain extent, I don't care whether or not a trade wins or loses. I'm trying to separate myself from the emotion of being wrapped up in any one particular trade. I've got 12 to 15 trades on at any one time, and as you were saying a few minutes ago, sizing of the trades, each one of those trades represents a small risk in my portfolio, and even if it were to blow up in my face, it's not going to wipe me out. And even if it becomes a huge win, it's not going to be something that makes me retire. I'm looking for a portfolio of trades which balance each other out, reduces the overall volatility of my portfolio, and makes me less emotionally dependent on one of them winning. So that's one thing that I try to do, is use diversification to be less emotionally wrapped up in any one particular trade. The second thing, I also have the plan. Just like every one of you have said, the plan is key. Going through the planning process, analyzing what could fail, how things can fail, why they can fail, and what are your actions that are going to, what your actions are going to be when that happens. I normally put stop losses in at a level that is pretty much, it tells me if I hit my stop loss, everything about my trade was wrong. My stop loss is more a point for me to wake up and say, I no longer have a valid point of view on this trade, I need to walk away. That's what my stop loss is for me. Beyond that, though, I also try to put down into my trading plan on any trade, what is the fundamental reason for taking the trade? And this is, I guess this is a little bit different from some people's approach, but I consider every trade in my portfolio as being there for a reason. And it's got to be a clear, unambiguous reason for taking that position. And I write it right out. Now, if that reason changes at any point in the trade, or it stops becoming valid, I close the trade. I don't care if I've, I don't care if I've hit a stop loss. I don't care if I'm positive. I don't care if I'm negative. I don't care. If a trade no longer has a reason to exist, it does not belong in my portfolio. So I guess I use that as an extra piece. I don't like to trade ambiguity. And by the way, Ed, I actually trade a lot more longer term than, I'm not a day trader by any means. I do a handful of trades that are around earnings that are a few days in length or a week in length, but the majority of my trades are anywhere from 20 days out to 120 days. And so I'm not necessarily whipping trades around left and right. So I guess there's my point of view on the whole thing, my thoughts. I don't know if I can add something to that, but I don't know, just talk
about I hate to cut off the discussion, but we're at an hour now, so well, you guys want to do a final thoughts and talk about your sites again?
Yeah, I'll tell you what. Let's go around the table. If you guys up for a suggestion of the week, and then ideally something that can be found on your sites or something that you can that people can look for on your sites. See, I'm jumping down to the bottom again. James, alphashark.com. How can we find you, and what should we look for to get on your site?
Right, so alphashark.com is our website. If you go there, there's a lot of different ways that you can kind of keep in touch with us. One, you can shoot me an email personally, james@alphashark.com. I get a lot of email, but I do my best to respond within 24 hours. If you have any questions about anything you see on the site or anything we talked about here today, please feel free to ask. On our website, you can sign up for a weekly webinar series that we give, where we give 6 webinars a week on a variety of different topics, not just options focused. So if you're not necessarily an options person, you can get some good information about futures, ETFs, and stocks from different moderators of our live trading room. And our blog also includes daily video updates on order flow and other interesting trades and ideas that we're seeing. So it's a great way to kind of keep up with what it is that we're doing.
Sounds good. And actually, James, I'll reach out to you. I mean, I mentioned before that I'm really curious about that institutional order flow on the options side, so love to talk to you on that. Ed, SeattleTechnicalAdvisors.com. How do we find you, and what should we look for? What would be the piece of knowledge that you'd like to give people from your site?
Yeah, well, it's like you said, SeattleTechnicalAdvisors.com, or you can just Google my name, Ed Carlson, you'll find it. Right now, what we're looking for is, fortunately, our Lindsay forecast matches up with the seasonality of a 8th year of a presidential term, which is a peak in early April, followed by a decline lasting until mid-June. And so, like I said, we're bearish on the market for the foreseeable future, for at least a couple months, and we'll take another look at it then. But that's what we're doing. If anybody's interested in looking at the work, feel free to come by the website and sign up for a sneak peek or trial subscription. Hope to see you there. Thank you.
Sounds great. Larry, PowerCycleTrading.com.
Yeah. Thanks, Doug. Yeah. Anybody out there, go to my website, PowerCycleTrading.com, and we've got a lot of nice free opt-in stuff that you can get on options and futures. So sign up there and then get on my list and be available for all my different webinars. I do a lot of free webinars each and every week and a lot of great courses, usually 2 or 3 courses a month. So a lot of good stuff going on. So PowerCycleTrading.com.
Okay. Is there something specific that kind of relates to what we're talking about today that you've got that's coming up that people can jump on?
Yeah, sure. We're going to be doing. Well, right now we're just finishing up on doing some earnings webinars, just to show you some different ways to use options for trading earnings, pre-earnings, earnings release, things like that. So get on our list for that. Also, if you get on our list and opt in, you'll get my daily, nightly videos of the trades that we're looking at, things like that. So always putting out a lot of different stuff. And I do a lot of stuff on the energy markets, which probably is a little bit different from a lot of the other companies out there trading or educating, because we do a lot of different spreads, crack spreads, front to back spreads, all kinds of different commodity spreads. So that's another thing that we focus on that you can learn at PowerCycleTrading.com.
Sounds great. Henry, to you, TradeAlert.com with a dash.
TradeAlert.com is us. Actually, if you go to whatstrading.com, you will end up in our newly built and more self-directed trader portal, which has a ton of content. We just released an interesting scatter plot that we're trying to come up with a name for it, but it effectively lets you look at all the liquid option names and see what's expensive and what's cheap and what's flat and what's steep. And then you can kind of look in the corners, and I was just looking at a trade in Harley-Davidson, which is lining up as very, very ramped up volatility and also very flat. And so it's really kind of interesting because it becomes a nice starting point to say, okay, well, when something's in that configuration, there's a put spread sale is actually kind of takes advantage of both the fact that it's jacked up and also that it's flat. Because you can make your money if the vol gets crushed, and you can make your money if the steepness just returns to it. And we have a coupon code. What's Trading 30 will save you 30% on the premium subscription there. So go to whatstrading.com and check it out.
Great. All right, and I'm coming to you from TopGunOptions.com. I was actually going to toss a couple of little trade suggestions out there, but these are just general concepts, and if you're an options trader, dig into this. I'm going to do something which is probably a bit unconventional here, and I'm going to sell you boring, because right now, especially dealing with the markets that we've had over the last month and a half or so, I like a little bit of boring, and this one is pretty darn boring. It's Calmain, C-A-L-M, Calm, and it is a consumer staples. They provide exciting things like chicken, but there's a fair amount of premium out there. There's a long time before the next earnings, and it's setting itself up for a nice, comfortable, wide, income-generating iron condor style trade. If you want to take a look at that style of trade, pop over to TopGunOptions.com. You can set up a chance to try out the rooms. I'm in the Advanced Live Trade Brief. And also coming up, we've got our full throttle course that's going to be coming up in the next couple of weeks, which I teach, and it's going over the fundamentals of options straight up through advanced techniques, 8 weeks of education. It's a great course. Love to see some people there. So on that, I think we'll hand it back. Are we good at this point?
All right. Yeah, thanks, guys. Good discussion. So just want to remind everyone watching, you can go to TimingResearch.com/reports to download this or any past reports there. Also go to TimingResearch.com/current survey next weekend to fill out the next survey and get have your responses be part of the next report. So I just want to thank my guests again, Henry Schwartz of TradeAlert.com and What'sTrading.com. Thanks, first time on the show, so thank you for being here. And Larry Gaines of PowerCycleTrading.com, Ed Carlson of SeattleTechnicalAdvisors.com, James Ramelli of AlphaShark.com. Thanks, guys, for being on again. And Doug Robertson, thank you for agreeing to host at the last minute here. So,
no problem.
Doug Robertson of Top Gun Options, and thanks for coming back. All right, good show, guys. Thanks.
Thanks, everyone.